The stock market is a great place to make your money work for you. One of the biggest enemies in the stock market is your own emotions. That's why it's important to have different strategies to keep the emotions out of the game. Hey, what's up guys? I'm Alex, and in this video we're going to go over the top 5 stock market investing strategies for beginners. Now smash that like button and let's get into it. Strategy number 1, buy and hold. The most underrated and undervalued strategy out there. What could be more simple than this? You buy a stock or an ETF, you hold on to it, and that's it. Market goes up, you don't sell. Market goes down, you don't sell. Market's flat, guess what? You don't sell. You're playing the long game, and you're not even really playing the game. You're just buying and waiting. That's it. This is a great strategy because it's so passive. You don't even need to look at what the market's doing. You're putting money in and taking emotions out. And then in 20, 30, 40 years down the road, you're gonna get 8 to 12% realized gains. Not bad for not really doing anything. Strategy number 2, dollar cost averaging. Dollar cost averaging is kind of like buy and hold, but you're just doing it on a regular basis. You pick a fixed dollar amount like $10 or $500, and then a fixed interval like every week or every month, every quarter, and to invest in stocks or ETFs, and then you just kind of sit back. So just like buy and hold, you're still investing your money in the ups, downs, and sideways, but you're just doing it continuously. What's great about this strategy is that when the market's going up, you're of course making money on your investment, but when it goes down, you're lowering your average cost of share so that when it rebounds, you're gonna make even more of a return. This strategy also takes the emotions out of it and makes it a lot easier to be robotic and not really look at the market. Strategy number 3, value investing. Value investing is when you look for and buy in undervalued stocks. Think of this like you're going bargain shopping. For whatever reason, these stock prices are lower than they should be for the current market. Now there's no way to perfectly evaluate a stock, but a few things to look for are consistent profitability, a good business track record, growing revenue, P/E ratio, and good leadership. The whole basis of this strategy is that you're trying to invest in good, solid companies rather than a stock, than a ticker. You're not buying AAPL, you're investing in Apple, the company Apple, right? Now, technically, a quality business will always be undervalued because they're continually improving, increasing profitability, and becoming more valuable. Strategy number 4, buy the rumor, sell the news. This strategy is exactly what it sounds like, but more accurately, it would be buy the rumor, sell before the news. This is because people are emotional and it totally affects the way that they trade. You hear good news about a company and the share price will just skyrocket and it's totally overpriced. You hear bad news and it's not even that bad, but then people get scared and they start selling off and then the share price just plummets. This strategy is based off capitalizing off of hype and fear. Take medical stocks, for example. Let's say that there's a company developing a new drug. The rumor is that this drug is going to cure some disease. In 2 weeks, they find out if they get FDA approval or not. So you buy the stock now because it's rumored that the drug will be very beneficial and thus profitable. Then right before they announce the news if they got FDA approval or not, you sell. You see, when you buy the rumor, you're buying the anticipation of good news, which usually inflates the stock price, regardless of whether or not there really is any good news. However, if there's bad news, the stock price is just gonna fall. This way, you're taking advantage of all the hype without the risk of if it actually comes to fruition or not. Strategy 5 is swing trading. The stock market is cyclical. There's ups and there's downs, and that's just a matter of fact, and it's gonna be that way forever. Swing trading is just taking advantage of those ups and downs in the short and mid-level time frame. This method is best used when basing it off of historical highs and lows, and is generally a little less risky than day trading just because you're giving the market a little more time. Remember, more time in the market generally means less risk. Now, swing trading is a bit more speculative and isn't too beginner friendly. If you can stick to some solid technical analysis, you can get some good gains and mitigate your risk. Now there's a lot of overlap in all of these strategies, and personally I like to use all of them. But the 2 key things you need to remember here are play the long game and take the emotions out of it. These are the strategies that I use when trading, but let me know down in the comments how you invest your money. If you want to see my video on investing in real estate, click on this video. See you in the next one.